Amongst all the layoffs and recession, a number of companies have also been reported to have gone bankrupt for reasons that might astound you. But why is it so? Why did these companies go bankrupt? What made them lose their consumer? Continue watching the video till the end to know more. Hey everyone, and welcome back to yet another video from our channel. We hope you guys are doing extremely well. In this video, we will be talking about the 25 big retailers and restaurant chains that have been filed for bankruptcy. We will be diving deep into every aspect of this news, so if you are new to this channel, then make sure to hit the subscribe button. Now, without any further ado, let's hop right into the video. Number 1. Chuck E. Cheese. Chuck E. Cheese's parent company filed for Chapter 11 bankruptcy in late June, citing the prolonged venue closures stemming from the pandemic for its financial troubles. The chain had $1.91 billion in liabilities on its balance sheet as of December 29. The company plans to continue operating as it undergoes the bankruptcy process. Number 2. Garden Fresh Restaurants. The parent company of buffet-style restaurants Supplantation and Sweet Tomatoes filed for Chapter 7 bankruptcy in May and closed all of its locations permanently. Garden Fresh had an estimated $50 million to $100 million in liabilities, according to its bankruptcy filing. The following month, the company liquidated its assets. Number 3. Le Pain Quotidien's U.S. arm. In late May, the U.S. arm of Le Pain Quotidien, PQ New York, sought Chapter 11 bankruptcy protection. The company had planned to file for bankruptcy prior to the pandemic, but restaurant closures nearly caused it to liquidate, according to court filings. PQ New York had an estimated $100 million to $500 million in liabilities when it filed for bankruptcy. Number 4. Vapiano. In April, the German restaurant chain applied to start insolvency proceedings in Cologne. The company is publicly traded on the Frankfurt Stock Exchange and has 6 U.S. locations. When Vapiano went public in 2017, it had a market value of about 553 million euros, or more than $630 million. Number 5. Food First Global Restaurants. The parent company of Breo and Bravo Restaurants filed for Chapter 11 bankruptcy in April and permanently shuttered 48 out of nearly 100 locations. Food First said it had liabilities of $50,000 or less in its bankruptcy filing. Number 6. Future Retail. At the end of July, an Indian court accepted the Bank of India's petition to admit debt-ridden retail chain operator Future Retail, FR, into the bankruptcy resolution process. The decision was made despite Amazon's efforts to oppose the move. The retail giant and FR shareholder claimed that creditors had colluded with FR to deny it its rights after battling for control of FR since 2019. However, much to the delight of FR creditors, Amazon's claims were dismissed. The ruling served as a major blow to Amazon's ability to compete with Reliance, its rival in the Indian retail market. Number 7. Revlon. The company had previously tried to prevent bankruptcy by taking on Citigroup as its loan agent. However, while the bank originally intended to send $8 million in interest payments to Revlon's lenders, it accidentally wired $900 million. At the time Revlon filed for bankruptcy, more than half of that sum had still not been returned. Number 8. Escada America. Escada America was born out of the previous bankruptcy of Escada USA in 2009, and the global Escada organization grappled with overexpansion, deficient leadership, and overpriced leases in the years that followed. This mismanagement trickled down to its subsidiaries, including Escada America, which left the company ill-equipped to endure the pandemic. The company has agreed to close 5 of its 10 U.S. locations as part of the bankruptcy process, and it plans to reorganize and repay its creditors. Number 9. Sequential Brands Group. As August came to a close, consumer brand owner Sequential Brands filed for Chapter 11 bankruptcy protection. The company ended 2020 with a debt load upwards of $450 million, which it had been struggling to pay down amid executive flight in the lead-up to its filing. While the company initially made moves to improve its financial standing by selling off large assets, those efforts proved futile, and Sequential filed for bankruptcy just 3 weeks later. Upon filing, it looked to sell most, if not all, of its assets and initiate a bidding process for interested buyers. Number 10. PaperSource. It saw declining sales due to pandemic-related store closures as well as a drop in demand for stationery as weddings and other events were canceled. PaperSource came under fire when it was revealed it had awarded executives a combined $1.5 million in bonuses during the pandemic, while reportedly leaving some of its vendors unpaid. In May, Barnes & Noble acquired the retailer, providing the necessary funding for PaperSource to emerge from bankruptcy. Number 11. Belk. Belk received speedy approval for its reorganization plan. Just one day after filing, the department store chain emerged from bankruptcy. Founded in 1888, Belk was struggling to adapt to changing consumer preferences even before the pandemic. It entered bankruptcy with a significant debt load, $1.9 billion, which it was unable to service as the COVID-19 pandemic put a damper on its sales. Number 12. Solstice Marketing Concepts. Sunglasses retailer Solstice filed for Chapter 11 bankruptcy in February, with plans to restructure. At the time of filing, the company said sales at its 66 stores were down more than 50% from 2019 due to pandemic lockdowns. In August 2021, the retailer emerged from bankruptcy after Second Avenue Capital Partners provided it with a $6.5 million exit financing facility. Number 13. L'Occitane. The U.S. arm of French beauty retailer L'Occitane filed for bankruptcy in January. At the time of its filing, the company was behind on $15 million in rent and was looking to exit 29 burdensome leases where its sales had fallen, claiming its rent at those locations no longer reflect the market. Number 14. Christopher & Banks. Minneapolis-based Christopher & Banks said it would close most, if not all, of its 450 physical stores at the time of its Chapter 11 filing in January. The company's former CEO, Carrie Janes, said COVID-19 hit the retailer particularly hard, as its average middle-aged female customer stopped buying new apparel in the absence of social engagements. Number 15. Love's Furniture. While Love's Furniture claimed that COVID-19-related supply chain disruptions were behind its financial challenges, its bankruptcy filings revealed that warehousing and inventory problems, which led to lost furniture, unhappy customers, and canceled orders, were also to blame. Number 16. Francesca's. Francesca's said it would close roughly half of its 551 locations in malls across the U.S. after filing for bankruptcy protection in December. The women's clothing and accessories retailer had already closed 140 locations before declaring bankruptcy following 2 years of losses. Number 17. Furniture Factory Outlet. Furniture Factory Outlet, which is owned by private equity firm Some Capital Partners, filed for Chapter 11 bankruptcy in November. At the start of 2020, the retailer had 68 stores across the U.S., but then supply chain disruptions and a drop in revenue due to the COVID-19 pandemic forced it to close 37 stores. Number 18. Guitar Center. The largest musical instruments retailer in the U.S. filed for bankruptcy in November. Already struggling against $1.3 billion in debt and online competition before the pandemic, Guitar Center was unable to overcome the loss in revenue related to COVID-19-related store closures. In December 2020, Guitar Center emerged from bankruptcy following an infusion of capital that wiped out $800 million of debt. Number 19. Gym chain UFit declared bankruptcy in November following a difficult year for gyms amid capacity limits and closures due to the pandemic. 24-Hour Fitness and Gold's Gym also filed for bankruptcy earlier in the year. As part of its bankruptcy deal, which was approved in December, UFit sold itself to a group of former lenders in exchange for debt forgiveness. Number 20. Stein Market. Discount department store chain Stein Mart long struggled with declining sales before it fell to bankruptcy in August. The chain had initially found a buyer in January 2020, but canceled the merger as the pandemic forced it to close its locations. The 112-year-old chain employed more than 8,000 people as of August and is set to liquidate all of its stores by the end of the year. Number 21. Tailored Brands. The company had been on the verge of bankruptcy for months, after sales declined more than 60% amid the pandemic. It announced in July that it would be closing up to 500 stores, over a third of its locations, and laying off 20% of its corporate staff. Number 22. Lord & Taylor. The oldest U.S. department store operator, Lord & Taylor, filed for Chapter 11 bankruptcy in early August and announced it would be liquidating all 38 of its stores. The nearly 200-year-old retailer was acquired by Hudson's Bay Company in 2012 and then sold to clothing rental subscription service Lettote for a paltry $75 million in 2019. Number 23. Muji USA. Japanese retailer Muji's U.S. arm filed for bankruptcy in July, one of the latest victims of the COVID-19 pandemic. Known for its minimalist, unbranded goods, the retailer plans to close some of its 18 U.S.-based locations but will continue to run its e-commerce store. Number 24. Sorla Table. Kitchenware seller Sorla Table filed for Chapter 11 bankruptcy in the same week as Muji USA. The retailer will close 70+ of its 112 stores and will sell its assets to Fortress Investment Group. The company was already struggling to stay afloat pre-pandemic, as online retailers ate away its market share and consumers shifted away from at-home cooking. Number 25. Storied menswear brand Brooks Brothers has grappled with evolving its brand in recent years, as more casual dress styles have become the norm, after it filed for bankruptcy in July. Retail management firm Authentic Brands Group and mall landlord Simon Property Group won the bid to buy out the brand by offering the zero-interest loan. And that's all for today. Did we miss out on anything? Do you have any other insights on this news? Did you enjoy watching the video? Let us know your thoughts in the comments section down below. Well, that brings us to the end of this video. We hope you have enjoyed watching the video. Please like the video if you have not already and make sure to hit the subscribe button. Don't forget to press the bell icon to never miss another update from our channel. With that being said, let's meet in another one of these videos. Until then, see ya!